All right, let's jump right into it. The Dow was up 603 points on Monday. The S&P 500 was up 90. This is as a result, of course, of the Congress passing the House, rather, passing the stimulus bill on Saturday. So there's some hope out there among these businesses and consumers as well that they're going to see $1.1 trillion coming into the American economy. I know what you're thinking. Well, the bill is 1.9 trillion. Yeah, that's true. But a lot of it is going to foreign aid, long-term transit projects, and funding for the arts. So the people, the engine, who are the people, us, we're the engine behind the consumer economy here in America. We're going to actually only get $1.14 trillion of the stimulus. In any event, it is what it is. Let's move on and talk about negative rates and how crazy it is. You ever heard of, well, we're going to have negative interest rates. We're close to that here in America, but over in Europe, they've had negative rates for some time. And when you have negative rates, your bank will tell you that, guess what? Not only are you not going to get any interest on this money you're putting into these savings products, but we're going to charge you to hold on to your money. That's exactly what's happening in Europe right now. So I just want to go over that with you because as we talk about on Money Changes Everything all the time, savings products make a limited amount of sense. After you are done building your opportunity account to stave off contingencies and to help you to be able to take advantage of opportunities, investment opportunities you might get. After you've done that, savings products really have a limited or after that, no utility. Also, you shouldn't even have all of your opportunity account in a savings product, savings, CDs, that sort of thing. You shouldn't have any of your money in a CD because it's not liquid, okay? And guess what? Take a look at the CD rates today. You're going to find out that it's not even, it's a joke, the amount of interest they're paying for you to lock your money in. From the Wall Street Journal, Germany's biggest lenders, Deutsche Bank and Commerzbank, have told new customers since last year to pay 0.5% annual, a 0.5% annual percentage rate to keep large sums of money with them. That's right. You have to pay the bank to hold your money in Europe. Now, the reason for that is because the European Central Bank is charging the banks in this environment. So the more customer deposits banks have, the more they have to park with the central bank. So the central bank is saying, hey, you got to pay us banks. So the banks are now saying, customers, you got to pay us. I don't know if Europe has the cash value permanent life insurance policy. I'm pretty sure they do, but apparently it's as popular in Europe as it is in America. Not very. And that's why you have individuals like Alex Bierhaus, who's actually a managing director at a fintech company in Dusseldorf. He received a letter from his bank, a unit of Commerzbank, last year, saying it was going to start charging a 0.5% interest rate on deposits above 100,000 euros. That's about 121,000 US dollars. To avoid paying, Mr. Bierhaus, whose savings ballooned without trips to restaurants and vacations, shifted 60,000 euros. This guy was having some pretty nice dinners and vacations. But anyway, he shifted 60,000 euros to a bank in Italy and one in Sweden through an online platform called Raisin, which allows customers to shop for better rates at banks across Europe. Mr. Bierhaus can't even remember the name of his new banks, but said he felt comfortable given that Europe has domestic guarantees on all deposits up to 100,000 euros, kind of like our FDIC. He is receiving 0.8% interest on the 1-year fixed deposits. So it sounds like he's got his money locked up for 1 year. I wouldn't mind receiving nothing for my deposit, but being asked to pay is just too much, the 34-year-old said. And he works for a fintech company, and he said he wouldn't mind having his money exposed to inflation, lose value, and not get a dime from the bank. He should keep it under his pillow or his mattress instead. So thank God we live in America where we have a place that we can put that money, that it will remain liquid, that it will get better returns than you're going to get at any bank in this country right now. And that has three key tax advantages: the advantage of allowing the money to grow tax-free, be accessed tax-free, and be distributed to heirs tax-free. So that's a little bit about negative interest rates. Now, on the flip side, negative interest rates also advantage you when you go for a loan. So there is that.